Digital Turbine Incorporated up 96% with latest news catalyst. Digital Turbine Incorporated and Subsidiaries. Quarterly report on Form 10-Q for the quarter ended December 31, 2024. By press release. The company reported a net loss of $insert amount and a comprehensive loss of insert amount for the quarter. As of December 31, 2024, the company had insert amount in cash and cash equivalents and insert amount in total assets. The company's condensed consolidated balance sheets and statements of operations and comprehensive loss are included in this report. The company's management's discussion and analysis of financial condition and results of operations is also included in this report. Financial performance overview. Over the 3 and 9 months ended December 31, 2024, AppLovin Incorporation, the company, experienced a decline in net revenue compared to the same periods in the prior year. Net revenue decreased by $7,997 or 5.6% for the 3-month period and $60,905 or 14.1% for the 9-month period. The decrease in net revenue was driven by lower performance across both of the company's business segments, on Device Solutions, ODS, and App Growth Platform, AGP. ODS revenue declined by 2.7% and 12.6% for the 3 and 9-month periods, respectively, primarily due to lower device volumes, partially offset by increased revenue per device. AGP revenue decreased by 10% and 16.9% for the 3 and 9-month periods, respectively, due to weaker advertising demand and the impact of consolidating and exiting certain legacy business lines. Costs and expenses. Total costs of revenue and operating expenses decreased by 3% and 30.9% for the 3 and 9-month periods, respectively, compared to the prior year. Excluding a $147,181 goodwill impairment charge recorded in the prior year period, total costs and expenses decreased by 8.4% for the 9 months ended December 31, 2024. The decrease in total costs and expenses was primarily driven by lower revenue share, general and administrative, and product development costs, partially offset by higher sales and marketing expenses. Revenue share decreased in line with the decline in total net revenue, as these costs are typically paid as a percentage of revenue. General and administrative expenses decreased due to lower professional fees, depreciation, and bad debt expense, partially offset by higher personnel-related costs. Product development expenses declined due to reductions in hosting, software, and third-party development costs. Sales and marketing expenses increased, driven by higher employee-related costs, including salaries and incentive compensation, partially offset by lower costs for sales events and travel. The company incurred $3,094 and $5,228 in business transformation, severance, and acquisition-related costs for the 3 and 9 months ended December 31, 2024, respectively, compared to $5,718 and $9,537 in the prior year periods. These costs are expected to increase in the remaining quarter of fiscal year 2025 as the company continues its transformation program. Profitability and cash flow. The company reported a net loss of $23,131 and $73,273 for the 3 and 9 months ended December 31, 2024, respectively, compared to net losses of $14,061 and $183,942 in the prior year periods. The improvement in net loss was primarily due to the absence of the $147,181 goodwill impairment charge recorded in the prior year. Cash provided by operating activities was $372 for the 9 months ended December 31, 2024, compared to $40,433 in the prior year period. The decrease was driven by the net loss, partially offset by changes in working capital and lower non-cash charges. Liquidity and capital resources. As of December 31, 2024, the company had $34,620 in unrestricted cash and cash equivalents and $694 in restricted cash. The company had $14,000 available to draw under its $425,000 amended and restated credit agreement, excluding the accordion feature, subject to the required covenants. The company's primary sources of liquidity are its cash and cash equivalents, cash from operations, and borrowings under the amended and restated credit agreement. The company believes its existing cash, cash flow from operations, and available credit facility will be sufficient to meet its working capital and other business requirements for at least the next 12 months. However, the company's ability to meet its debt service obligations and fund its operations will depend on its future performance, which could be impacted by macroeconomic factors, geopolitical developments, and the company's ability to effectively implement its transformation program and generate additional revenue. If the company is unable to effectively manage costs and generate sufficient cash flow, it may need to seek additional financing, which may not be available on favorable terms, or at all. Breakouts recap. A 55% plus breakout out of market open. A steady 20% breakout in late regular trading session.
Please like the video and subscribe to Hot Stocks Replay. Thanks.